Hello, welcome everybody. Welcome here to tonight's event. My name is Elise, I'll be your host for tonight. Today, talk is about building castles in the sky. This is from the London Innovation Society. It's in collaboration with Level 39, where we are at this moment. Today's talk is going to be from a truly inspirational investor, Hussain Kanji. He's a co-founder of Hoxton Ventures, and he has been investing in a lot of startups. For example, we all know Deliveroo, for example. And the first one to call up here is Kunal. He is from Level 39, and he's going to tell a bit about Level 39 and how this is one of the world's most innovative tech places.
Hi everyone, thanks for coming, and firstly we're honoured to have Hussain from Hoxton Ventures here with us. And Level 39 is a technology community which has loads of different types of activities, from 210 technology-based companies here from a wide range of verticals, along with weekly events. In total we've had about 1,200 tech-related events over the last 4.5 years. And if you want to get involved, just check out our website, level39.co, or email hello@level39.co. Next week, we're also throwing, on next Thursday, a VR, AR exhibitor and demo day in the evening. And we've got about 10 plus exhibitors coming down, about 14 different speakers, even a VR F1 car, and there's a scoreboard as well. So I hope to see everyone there. Just go to our website, email us, and we'll get you access. Thanks very much.
Thanks, Kunal. For today, we normally have feedback forms, but today we're going to do it differently. We have a WhatsApp channel. The number is over there. It would be really great if all of you could sign up and just say hello. And then at the end of the event, there's going to be a question, like feedback question, about the event of today. And yeah, we hope you would all do that to help us. So as said, this is the third event hosted by London Innovation Society. And I would like to ask to stage Dr. Sullivan, who's going to talk a bit about the story behind the London Innovation Society.
Thank you. So, welcome everybody. Thanks for joining to our third seminar series of the Building Castles in the Sky. We have been trying to put together a series of events who would inspire to be entrepreneurs or the current entrepreneurs trying to find their ways around the UK's ecosystem of startups. Level 39 is one of the most collaborative places to do such activity, and we are really honored to have their support behind us. Now, today we have Hussein Kanji, who will be giving us in-depth understanding about how getting investment is going to work out for new startups. But before today, we had also some really nice stories from Halal Booking founder, and also Fahri Karakash, who was the lecturer from University of East Anglia, talking about entrepreneurship. And we will continue to have different aspects of investment entrepreneurship covered during the series. What else do we do in London Innovation Society? We try to encourage youngsters and also sort of semi-professionals to think about starting up their own businesses and try to fulfill their dreams. To do that, they need certain skills and they need network. So what we are trying to do is help people establish their network as well as build up their skill set. So for example, on Saturday, we are organizing a course here to give some coding practice to youngsters from secondary school age with BBC Microbit. Maybe you are not familiar with it, but it's a really simple controller card that helps people to learn about how to code without getting bored. And we are really looking for volunteers to help us with all of our activities. There are a variety of things that can be done to help us, from marketing, from just helping the kids, and also putting together these events is a lot of team effort. And I would like to just highlight that most of our setup is being fulfilled by multiple volunteer people. So I would like to thank all of the team as well. So now I would like to ask Elise to continue with this. Thank you for coming.
Thank you, Simon. Before we ask Hussein to stage, if you all want to be up to date with our next event, you can either follow us on social media or via our WhatsApp channel. And if you have any questions, I'll be over here. At the back there are drinks, so if you feel thirsty during the event, you can just go there and grab a drink for free. And now I'd like to invite Dr. Hussein.
Everybody, thanks for coming. So I thought I'd talk a little bit about, just give you a quick intro about myself and the firm that I run, and then talk to you about how we make investment decisions, which may be a little bit different than the way other venture folks, at least in Europe or in the UK, think about things, but would probably be very consistent with the way most American venture firms would operate. So just a very quick background. We started the firm in 2013, so we're about 4 years and 6 months, maybe 7 months now old. We've done pretty well. As you can see, we've had the good luck of investing in a couple of companies that have become iconic. I think Deliveroo is probably our biggest company right now, but I think Darktrace is very likely to become an even bigger company. And then we have a few companies that I think will turn out to be reasonably large companies. Babylon Health might be another one. TourRadar just closed $50 million. So we've done reasonably well as a firm. Before Hoxton, I was at another venture capital fund. It's a much bigger, much more important fund than our fund, Accel Partners. And I left kind of in the 2010 era to go build Hoxton. It took a long time to get money for our fund. So what a lot of people don't understand is we ourselves fundraise every once in a while, about every 3 to 4 years, to get a pot of money. Some of it's our own capital, so that's actually easy to get. But we end up raising money from other folks. And in Europe, unfortunately, back in the early 2010 kind of time frame, when we put together our slide deck to say there were companies that could be built in Europe that were going to be very large, iconic tech companies, you could come up with the logo for Skype, and then you would like scratch your head about what other logos to put on your slides. And when we went to investors and saying, look, there are going to be some interesting companies here in Europe, I would say like 99.9% of investors, these are like large pension funds, university endowments, etc., didn't believe a word we were saying because there was no real proof that you could build these kinds of companies in Europe. So that makes it really difficult to fundraise. But we got up to speed and got going. And before I was doing any of this venture stuff, I was working for predominantly startups, and I spent a little bit of time inside of bigger technology companies as well. So like many folks in the Bay Area, I went to Stanford, and like many Stanford folks, I ended up working on a startup when I was still at Stanford. That startup got acquired while I was still at Stanford, and I spent about 2 years in the advanced technology group at Sun Microsystems. So learned how a bigger technology company, which was predominantly a hardware company back then, thought about the world. Went off to do another company that didn't go anywhere, so failed pretty miserably. So I have a lot of empathy for the kind of situation most founders are in when things are not working. And then joined a friend of mine, someone became a friend who was an advisor to me, his company, which had a very easy time raising capital. We raised about $35 million within the span of about 2 years, so quite a bit of money. Post-dot-com bubble, so this was actually even more interesting because back in after the dot-com bubble collapsed, it was actually really hard to get money, but it was fairly easy for him to get money. And then we struggled for another few years trying to figure out how to build a product and get product market fit. Back then, the word product market fit didn't exist. And eventually that business got sold to Comcast for about $10 million. And virtually every mistake that an enterprise software business can make, we probably made, which is a good learning experience. And then I teamed up with an angel investor in that business who was one of my professors at Stanford, and we spun out a research project out of a big research lab in the US. And it's the only one of my products that you would have ever seen or encountered because the other businesses were kind of niche. When you go through airport security, there's a big machine next to the X-ray machine, and you put your hands above your head and it spins around you like this, and it doesn't cause any cancer. That's what people are afraid of. But that's our machine, or that was the machine that we spun out, and we turned that into a company. And about the investment thesis was super simple. Post 9/11, you're going to need some new stuff inside of airport security. There was some research that had been going for 15 years that was never commercialized. If we could take the research out of the lab and turn it into a company, you might actually make some money. I think we sold like 20 of these machines, like literally 20, like not very many machines, mostly to the Stans, so like Central and Eastern Europe. We didn't sell very many in the US. And L3, which is the company who makes the machine today, acquired the company for $135 million. So pretty, no worries. Make it louder. Sorry. So L3, who makes the machines, they bought the company for $135 million, which is pretty good. And I don't think they sold very many for another 2 years, and I think they scratched their heads whether this was a good acquisition or not. And then the regulatory environment in the airport has changed. And today, I don't think you can go through a major airport without seeing at least one of these machines, if not these machines, at every single station when you're at security. So I think it's turned out to be a really, really good acquisition for them. So that's kind of my background. So learned a little bit about the venture business simply by being on the other side of the table, which I think is the usual training ground for most VCs, and then learned the business inside of a big venture fund, and then peeled off to try and do it myself. So that's the kind of context. In terms of investments, so we have a pretty simple investment strategy, and most people don't believe that it's that simple because people like making things, I think, a lot more complicated. We like investing in mostly brand new markets. So things that, the question that we ask ourselves as investors is what's changed in the market that allows this product or service to exist today where it couldn't have existed a year ago or 2 years ago or 3 years ago. Our general belief, and there is some data behind this, is that if you're in an existing market and you're trying to build a better value proposition for your investors, it's just too damn hard. You can win, but if you build a product that's like 5% better than what else is out in the market, it's really hard to sell it, right? But if you build a product that's like 40-50% better, which is like materially different, you think that it will have a much easier time selling it, it's still really hard to sell it. The world is very stacked against new companies and against new products and services if you're selling against something that already exists in the market, even if you're materially better. Usually the distribution channels are screwed up, you don't have access to customers as easily. Customers are incredibly risk averse, right? So they don't like using next generation stuff. They like kind of sticking with the stuff that works. And there's this old expression, like no one ever got fired for buying IBM. And people really do worry about like losing their jobs if they make the wrong bet. There's very little upside, right? If you go off and save your company 20-30%, it's very unlikely that you're going to become the CEO of the company and like all of a sudden be on like a fast track position. But if you buy something and it goes the wrong way from a younger company, you could get fired, right? So it's not a decent risk return for a person. So our general view is we avoid all that stuff. We like backing brand new kinds of businesses in brand new kinds of markets. And it's a very high risk, high reward type scenario, because if the market doesn't take off, if we are too early, a year, 2, 3, too early, either we have to put a lot more money into the business and keep it going, or the company goes out of business and becomes like an acqui-hire at best for someone. But in the rare event where it goes really well, we can make a ton of money, and the startup usually has no real competition other than itself in the market. And if you look at most of the interesting technology companies that have become kind of household names, they're mostly brand new markets, right? So like the entire PC industry didn't really exist. Like the application software industry didn't exist when Lotus 1-2-3 came out. It's like the first spreadsheet. Actually the first company that built this stuff was VisiCalc, which people forget about, right? But the only real competitor was VisiCalc, and then afterwards Lotus 1-2-3 came out, right? There was no such thing as like an operating system type company. I mean, there's operating system that gets bundled into your PC, but like there was no like third-party operating system company until like DOS came out and then Windows came out. The Mac invented a brand new market, right? There was no social networking market. There was Friendster, but there was no social networking market, and there was MySpace, but Facebook was basically a new entrant, and then I think figured out the formula better than the other ones. But to be fair, MySpace was a pretty big acquisition as well. Disney acquired it for a few $100 million. I think it was like $700 million. So brand new markets, when they take off, can pay off asymmetrically. And we as investors, we really don't worry about losing that much money, because no matter what stage we're investing in, we generally tend to lose about 40-50% of the time, which means about half the time that we write an investment, we're going to lose either some amount of money or all of our money on that investment. So we have a super high failure rate within, and you can try and, there are two ways of making money in this world, right? You can try and minimize your downside, or you can try and maximize your upside. And you can try minimizing your downside by trying not to fail as much. But when you're backing brand new businesses, you have very imperfect information. You have no idea if the people that you're backing are going to hit stumbling blocks downstream. And then the worst thing is you have no idea about how the rest of the market's going to work, right? So you think you've invested in something really good, it's going really well, and all of a sudden Amazon, for some reason, decides that they're going to enter that market. How do you control for that, right? So you can't control for that. So we've trained ourselves to worry a lot less about the downside, and we've trained ourselves to worry really about the magnitude of the upside. So the only thing that makes up for all the mistakes that we make, and you can see not all of these companies are going to be great companies, and we'd love if they were, but that's generally not how it works. The wins have to be so big and so asymmetric that they cover up all of our mistakes for the good ones. And that generally tends to happen when you have new markets. If the market takes off and you're the early pioneer, you could potentially turn out to be a multi-billion-dollar company. So then that leads us to the second thing that we look for. So the first thing is brand new categories. The second thing, which is we want to find multi-billion-dollar type companies. It's not interesting for us to invest in something. And so the easiest trade-off for us right? And it's a question that we often ask ourselves, and it's how most venture firms, unfortunately, in Europe think. If you gave most people the chance between taking $1 million and turning it into 10, but with like a very low failure rate, or taking $1 million and turning it into potentially several hundred million, but with an astronomically high failure rate, even if you weighted this, the expected value was higher of the second versus the former, so the high risk thing would make you more money on an expected value basis. Most investors in Europe would prefer the first, to take the safer route, and then prefer the smaller outcome versus the bigger outcome because they just don't like the risk. We 100% default into the second. And if we can't make all of our money from one investment, and that's the bar for us, if the thing lines up and the company turns out to be a very big type outcome, if it can't give us all of our money back in the entire fund, and usually multiples of the entire fund, it's a pass for us. And for us, often that means that the business has to become a global business. And we get beat up a lot because a lot of people think that we're anti-Europe because of this. But I would argue if you're building a company and you're going to focus on the market here first, especially if you're an enterprise software company, a little bit less so if you're a consumer company, but if you're going to focus on the market here first, you're kind of doing it in the wrong order. You know, you should build it here because I think there's a big cost advantage to doing things here and there's incredible talent here, but you should probably win the market in the US or win the market in China before you think about winning the market in the UK. They're bigger markets. You'll be a much bigger company. You'll be 100 times more competitive, but it's like almost like, think about yourself if you're a football player. If you're a football player, you want to play in the Premier League. That's where you get all the reward and the attention. You don't want to be playing in like a small league, like in some smaller country. So it's much more competitive, but if you win really big. And to us, you win big if you become kind of the global category leader in your field. It's hard to build to that kind of scale if you're a local UK-oriented company. You can build a really good business in the UK. Zoopla is a really good example. Rightmove is a really good example. But it's just really hard to become like $100 billion company if you're just focused on the local market. So we tend to avoid those kinds of things. Then the last thing that we look for, and these are the questions that we ask ourselves usually when we're writing our investment memos and looking at companies, is we care very little about the people who are founding the business. Obviously we care something about, because those are the people we're working with. We care less about their backgrounds, because if you again look at most early stage companies, most of the really interesting companies are usually done by first-time founders. Maybe it's their second or third startup, but it's their first potentially big, like, successful company. Usually if you have a very big successful company, it becomes your job for like the 20 years. Like, if you're like a Bill Gates, like, you work at Microsoft until you decide to retire and give your money away to charity. If you're Mark Zuckerberg, it's the same kind of thing. So if you're successful, it's like super mega successful, your company tends to be your company. There are a few counterexamples to this, like Elon Musk is a counterexample, but largely speaking, most serial entrepreneurs build smaller companies than the mega successes, because the mega successes kind of consume your life. We're looking for mega successes. And most of these mega successes are built by people, again, age doesn't matter, but it's like their first significant real company. So they may not actually have all the expertise that you expect someone who's very, very well trained to actually have inside the company. So what we look for is we ask ourselves, who are the people that they're recruiting around themselves? So even if they're very young and very inexperienced, they're usually able to hire several levels above themselves. And so that makes a big difference. It's a big signal to us. So really good companies tend to hire really good people. And in the early days, it's actually it's very difficult to hire really good people, but it gets really hard to hire really good people at scale because you just have big numbers. And if they can't do it in the early days, it's very unlikely that they'll do it in the later days. So we tend to look at who they recruit around themselves. And if really smart, competent people who should not be taking this kind of career risk are joining the company, it's a really good signal for us that either the founder is incredibly charismatic and is able to sell anything, right? Or there's a really powerful idea there that other people in the world are recognizing, and it makes it much easier for us to invest. The founder could be like a 22-year-old dropout from a university. That's less important to us than the caliber of people that he or she has surrounded himself with. Those are the main things that we kind of look for. Most of the things that you think investors look for, like a cash flow statement or a P&L statement, or a financial model, we really don't care about, because we think, generally speaking, they're going to be wrong, right? We hope that they're going to be wrong in the wrong direction, which is you build this silly model for 5 years, right? Your ability to forecast anything when you're a small company, like even 6 months out or 12 months out, is like pretty limited. Try forecasting like 3 years out, right? Either you're going to knock it out of the park and then all those models are going to have to get readjusted, or you've got it wrong because you're like overly optimistic. We care a lot about the underlying economic business. Like, is there a business there at the end of the day? We actually don't care if there's a business here today. We care about what happens, is there a business there when you actually want to generate money? So we do worry about that, but we don't worry about the models and the forecasting, apart from 2 things. We worry a lot about who do you have to hire and how much is that going to cost. And we worry about when you're going to run out of money, and will you have enough money in the bank to be able to get to the next stage where someone else can take a bet on the company, and the company is materially improved, where it's much more obvious to the next investor that they should give you money, assuming you're not going to get to cash flow positive, which most tech companies won't in the early days. So we worry a lot about, do you have enough money in the tank to be able to sufficiently get to the next milestone? And most next milestones, if you're an early stage company and you're building your product, the next milestone is building the product and maybe getting some early references. If you have your early references in your product, the next milestone is actually building a machine that can scale, right? Either you're acquiring users very easily or you're acquiring customers very easily if you're an enterprise software company. You know, there's a definitive next milestone, and usually it takes about 12 to 18 months. It's very hard to do in like 2, 3, 6 months. So we worry a lot about that. And then the last thing that we ask ourselves, and we started doing this after about our first year, and we didn't used to do this in the early days because we didn't know about it, is we have a paragraph in our investment memo that says that if we got hit by a bus, would the company still succeed? In other words, if they need our help, we don't invest. We're very helpful investors. We tend to take a board seat. We're super good about making sure our companies are successful. We work really hard behind the scenes. But if they need our help to get from point A to point B, something's wrong. We're investors, right? We write a check. There should be no dependency on us. What should happen is the company is trying to do a strategic partnership with Samsung. Samsung's a big, slow Korean company. It's just the way it's wired, right? And so it will take like 6 months, maybe as much as a year to get the deal inked. If we happen to know one of the senior VPs at Samsung, we can pick up the phone and make that deal happen in like 2 months or 3 months. But to be quite honest, if the company can't get the deal done on its own, no amount of help from us is going to be able to get them across the finish line. So we've trained ourselves, and it's really hard because we like helping, and we used to be business people, like as if we were in these types of companies before. But we've trained ourselves to try and pick companies that are going to be successful with or without us. Obviously, we want to help the company, and obviously the company usually comes to an investor not just for money, but we don't pick companies that we're required to help. And that's it. That's our super simple formula. If you look at our portfolio, these are the kinds of bets that we make, right? So like, you know, the obvious successful ones, and people know, but the ones that are probably less successful, Mainframe just did an ICO, so maybe it will become successful now. But you know, they were trying to reinvent email. Like their big idea was in an era of like mobile phones and kind of next generation communication stuff like Slack or WhatsApp. Why is email still such an old world paradigm? What happens if we rethought email from the ground up? And we were pretty convinced that if you could do this, you could actually build a really interesting company. I think that one's been slower. I mean, we'll see what happens in terms of their product evolution now, but there are a couple of other companies that have run with that same problem and done really well in the Bay Area. There's one called Front that's doing incredibly well. So it's the same kind of thematic stuff. And usually for most of our companies, it's not just our company or our investment that's the only company in the space. Usually when there's a new market that opens up, you know, 5, 10, 20, maybe as many as 50 companies pop up. Like when the Bluetooth standard came out, there were about 20-something silicon companies all trying to be the first to market with a Bluetooth chip. And a couple of them turned out to be big companies. Here domestic, it was Cambridge Silicon Radio. And in the US, it was Atheros, which also did Wi-Fi stuff. So number one, number two make all the returns. So that's roughly how we think about the world. You know, we've tried to communicate this stuff on our website. So our website, if you look at it now, it will say all these things, but it's probably not obvious, to most people that this is how venture folks think. At the end of the day, we're just very, very fancy stock pickers, and we're trying to pick companies that are going to go from point A to point B, and do really well without really, but just by writing a check. And most of us, we're in a business where we have to train ourselves to kind of be lazy in this sense, because you want to force yourself to pick really well, because if you pick really well, everything else lines up. If you pick really poorly, you can spend all kinds of energy to try and fix the company, but it's actually really, really, really difficult. So we tend to focus a hell of a lot more on the picking side than anything else. So that's kind of a bit of a snapshot, and I thought what I'd do is make it a little bit more interactive and take questions, because I imagine many of you are building companies and thinking about fundraising, so I can probably be more effective if I take questions. Yeah, I'll repeat it so that it's on the mic. What kind of what? So the question is, what kind of value do we put on IP or patent protection? In software, very little, right? I mean, you can't really patent a software. You can patent a technique, but you can't really patent the core idea. Once in a while, the patent examiner screws that one up, and like you have something like the one-click patent. But in general, most of the defensibility in our industry, at least on the software side, comes not from the design of the thing, but the scale of the thing. And so we assume, like, a company that completely ignores patents is probably a bad idea, because it's just not running a very good business, and you should defend the stuff that is defendable. But something that's relying on patent, like patents to build scale, that's not how scale works. That's just a defensive. It's a defensive thing, not an offensive thing. And even the handful, there have been a couple of patent, they call them patent troll companies that are designed to collect patents and then sue. Even those things haven't made that much money. So even on the offensive side, with very established patent portfolios, you don't tend to do that well. So it's more of a defensive thing than anything else. The single biggest mistake that we often see, at least in Europe, is most people usually, when they're building a company, get from building the company to building the product. So like they get from point A to point B, and where they usually fall apart is going from point B to point C, which is building a repeatable sales machine. That to us is usually the super hard thing in Europe. It has nothing to do with IP, but that's usually where we see people stumble. And we have a theory around this, which is if you look at most, and again, this doesn't apply to consumer businesses, it definitely applies to software businesses. If you look, most of the really good salespeople in Europe are usually working for other tech, like most of the tech salespeople are usually working for very large established brands. And if you think about their job in life, like whether you're at Oracle or Microsoft, or you're selling ads at Yahoo or Google or Snapchat, right? Most of the work that you're doing is kind of done for you, right? If you rock up and you're selling Google or you're selling Microsoft or you're selling Slack, the product, service, company is well enough known in Europe that it's very unlikely you're creating demand or creating sales. You're just literally taking the order. It's more nuanced than that, but you're more of an order taker than someone who can generate brand new leads. And so there's not a big training ground. And unfortunately, most of the founders that we meet don't come from the sales side. They usually come from product side. And this happens even in California. So they don't often know enough about the weaknesses of their salespeople. And so you get your first few reference accounts because you can persuade people to use the product or service. But then trying to build this thing into a very repeatable sales machine where you can hire like 50 salespeople a year and keep this thing going and get to hundreds of millions of revenue is really difficult in Europe. And most founders, unfortunately, don't know that stuff and don't understand that stuff and don't appreciate that stuff. I think most of the value in the enterprise software business, there's value created in the very beginning when you build the product, because you need a product in order to get anywhere. And then most of the value for the next probably 5 to 10 years is how effective you make your sales team. You don't need to have the best product in the world. You need the best sales, the best sales processes in the world to really get to scale. And then once you're a very large company again, you need to think about product again, because you're not just going to sell one thing, you're going to have to sell a whole platform and a whole suite of things, and you have to think about product innovation again. But the bulk of the venture-backed stuff is going to be about how effective you are at selling. And arguably, in the consumer market, it's a little bit different. In the consumer market, the product or service makes a big difference, and customer acquisition can be much more viral, and so you're not as tied to this kind of stuff. But at least if you're building, products or services that you're going to sell to enterprises, that's where most of the value is, and that's where most of the companies, unfortunately, don't do as well in Europe, because the DNA isn't as robust.
That's okay.
I'll repeat it.
Yeah, it looks like you are fine with the idea which is have to monetize. Would you ever consider investing multiple times?
Would we consider investing multiple times in the same idea?
Yes, same company.
In the same company?
Stage later.
Yeah. So when most VCs raise money, and it's a little bit less true of smaller funds because we just have less money under management. But most of us, when we invest, we put money into the company, and then we put money into a virtual bank account for future money, for future rounds. What ends up happening is there are three scenarios, right? So company does incredibly well, right? You find a Deliveroo, you find a Darktrace. Your fund, right? Imagine that you put half of it away for future financings. When you find a Deliveroo and Darktrace, you may not get the same 100x that you do from day one, but you're going to get a 20x or a 30x and then a 5x, and then it will come down over time, but it will be an x. So that money that you have parked for that company will get a return with very little risk compared to everything else that you're going to be investing in. So from a fund management perspective, your returns actually go up significantly if you're able to follow these companies. That's what happened in a really good scenario. In a really bad scenario, the company tried to build something and completely failed. It's a dud company, it's a bad CEO, it's a bad founder, you never want to work with them again. You don't want to put any money in. And then there's the middle, which is unfortunately the hard part for us as VCs, right? You see something, but nobody else in the world sees it. But you're convinced, and you work enough and closely with the founder, and if you don't write the check, the company's going to go bust. In an ideal world, the company's going to fly, or it's a clear no, but most of our reserves, and if you don't write the check, the company goes bust. You have to have this money available, right? In the first scenario, you want the money to be available because it's kind of like the free return, right? It's going to be the good return for your fund. In the last scenario, you want no money available. In the middle, right, if you don't invest, maybe other people won't invest because they don't believe that it's a good company unless you're putting some skin in the game. So you have to have this money around. Unfortunately, when you're a very small fund, this was less true when I was at Accel. When you're a small fund, every dollar really counts because you don't have that many dollars under management. We're a $40 million fund in our first fund. It makes a bit. We're spiking up our second fund to be significantly bigger. But the reason for this is because it's really hard to make these decisions when you only have 40 million to play with. So you tend to keep investing all the way through.
What did you do up to now in such cases?
So eventually there comes a time where, and most shareholders agreements allow you, if you're an existing investor, to keep participating in the upside. It's called your pro rata right in the future rounds. When you have companies that go off and raise $100 million plus, assume for a second that you own 5 or 10% of these companies. Right? So if 10% of $100 million bucks is $10 million bucks. If you have a $40 million fund, you can't put $10 million to work in that. It might be a lot of free money, but you don't have the money to do it. Well, what a lot of funds do in the US and here when they're smaller like this is they go back to their investor base. So they go back to the endowments and the pension funds that are behind them, and they try and put a wrapper around that money. So it's the fund investing, but they create a brand new structure, effectively like a mini fund, to just dedicated to putting more money in. It gets hard because sometimes these financings happen and they happen really fast, and you don't have very many degrees of freedom to be able to do all this stuff, or you waive your pro rata. And usually in these good companies, everyone wants your pro rata, because if you can't pick it up and they're raising 100, there are plenty of other people who want to pick up that extra 10 for themselves. So you play it by ear. I mean, it's part of people think a lot about the venture business as the upfront picking, but a lot of our job, because we're fund managers, this is the kind of stuff that we have to worry. The entrepreneur doesn't have to worry about this at all. It's never exposed to them. This is like where we spend our like sleepless nights trying to figure out how we're going to allocate this like rest of the capital. And then when we do the same idea over and over again, and we have to really know why it didn't work the last time around. To be fair, sometimes you have a lot more of that insight up front, because if you invested in X and the market didn't take off, you probably have pretty good information on where the state of the market is. Unfortunately, usually when you invest in X and it doesn't work, you get very cynical. And you usually conclude that the market's never going to be there. So, because once you get burned, it's a very natural human response to feel, it's never going to really materialize. So like if you did like VR back in the late 90s, you probably wouldn't come back and do VR today. Market may look very, very different, right? But you have to really convince yourself. So it's a very human instinct to not do that. But to be fair, if we missed the timing, the company didn't work, but the market's now going to take off, we'd much rather do it. But it's very hard for us to overcome this human bias.
Do you have a typical time horizon before you exit the business, or you look how it's progressing before you make a decision, whether it's 3 years, 5 years? What's your typical thinking around that?
Yeah, it's a good question. So most of us who are venture folks, we run funds. Almost all the venture funds in the world largely follow the same pattern. We're 10-year funds. And we usually have a certain amount of renewals where we can extend the fund, usually with some consent of the investor, sometimes with very minimal consent of the investors, and usually they're 2 one-year renewals. So it's like 10 plus 1 plus 1. So the most a fund can run usually is about 12 years. Most of us invest in the first 3 years of the fund, sometimes the first 4 years of the fund. So if you're the last investment out of a fund that spends 4 years investing, then the founder has 8 years until there has to be some kind of liquidity event for the fund. The founder may not have to sell, but we have to sell our shares somehow. It's obviously the easiest to sell our shares when the company is bought or when the company goes public, because we can give the public shares to our investors. So we generally have that kind of view. Our investors they like it when funds make a bunch of money to get them liquidity as soon as possible. So our investors are probably more short-sighted than us as fund managers. So because when you see this massive gain, you want the gain to not be on paper, but to turn into like into cash and then come back to you as an investor versus sitting in this like in this fund where it's just on paper. So we get pressure from our investors to sell some of this stuff, especially when they're early gains. Our view is there are always maximum points, like local optima points on valuation, where sometimes a company can get massively overvalued relative to its fundamentals. If that happens and we think the growth is not there in the business, we are very happy to sell out. Assuming that the founder is also going to sell out, and we would encourage. So if you ever go through one of these scenarios where the market looks really hot, the business looks amazingly good, there are acquisition offers coming, but you internally think the long-term fundamentals are kind of against you, and people are willing to pay you a massive premium to what you're actually worth, there is a time and place to get out, especially people are making you foolish offers, right? Unfortunately, we have very little perfect information. All of this stuff looks much better in hindsight. But if you believe that the core fundamentals for the business are very good, there's no reason to sell. If you were an early venture investor in Amazon, would you want to sell that company 5 years after it was founded? Would you want to sell it 10 years after it was founded? In an ideal world, you want to hold for as long as possible. And our heuristic is as long as the company is exponentially growing, it's compounding growth, you probably want to be a holder, unless someone's going to pay you such a premium relative to the future growth today that you then want to get out. And the alternative to that is if it's not going to grow and someone's willing to pay you a big price, you want to get out. Otherwise, you want to hold. And we tend to want to hold our businesses for a very long time, to the maximum duration that we possibly can. And our fund gives us the flexibility to be able to do that. We don't need to, we have to be respectful towards our investors, but our investors don't control the fund. We do. And most venture funds are very similar to us. But I would say in Europe, most people want to sell out much earlier in this chain, right? Because the decision-making chain isn't just a company. It's the investor in the fund, then it's the fund, and then it's the company itself. And in Europe, all three stages usually want to sell out early, unfortunately.
So how do you manage your valuation process? Because I see India here, Germany, and United Kingdom. So it should be quite different, right?
Yeah, so the India one's kind of a cheat. So we had a really bad company, which got a term sheet from a very large venture fund. And I called up the venture fund, and they said, we're not going to talk to you. You're a junior person. And so when they presented their term sheet at the board, I didn't vote for the term sheet. The company was, by the way, really bad. So it wasn't just the fact that this venture firm insulted me. And we forced the company into bankruptcy, and we restarted it from scratch. It was our only way to get rid of the founder as well. That was like our worst case story in the fund. We've never had something like this, but this was like literally the poorest run company I've ever seen in my life. And unfortunately, we're minority investors, right? So we're along for the ride. You can't do anything. You have a board seat. The founder has a board seat. There's another independent board seat that's a friend of the founders. You can't do anything until the company actually physically runs out of cash. When the company physically ran out of cash, we rebooted it from scratch. We really believed in the business. We just let the businesses run really poorly. And then a classmate of mine from business school decided to do a buyout with us of the assets. He effectively bought the business out. We put some more money in it. And then the first thing he did was, it was a very people-intensive business. He said, I'm not going to hire British people to do this because it's just too expensive. And he moved the entire business to India. So we now have a UK company, but with a lot of staff in India. So that's the India part. Otherwise, we only focus on Europe. Most of our companies move to the US. So most of the rest of the stuff that we do is, it's Europe with an angle that goes to the US. Valuations are reasonably different in all of these places. But the way we normally do valuations, and the way most of the West Coast does valuations, and remember I said, you tend to want to invest in the company so it has enough money for 12 to 18 months. If you put less money than that, the company is at risk and your investment is at risk because their ability to get to the next big milestone is compromised, which means you're not going to see a step up in valuation, which means very likely that company is going to come back to you for more money. So if you don't write the right size check into the company, you're never going to really get to that next stage, and so you're not going to make you're never going to see, at least on paper, the gains that you want to see. The company's heading in the right direction. And once companies stumble, it gets much harder to raise money, right? You never want a down round or a flat round. You always want to gear it so it goes.
I see you consider burn rate.
I'm looking at burn rate, right? And then, so that's the lower bound. That's how much money goes into the company on the lower side, right? It's whatever gets you to 12 to 18 months. The upper bound of that is how competitive is the market, right? If the company needs $1 million, but everyone here wants to invest, supply and demand, the company's not going to raise $1 million, it's going to raise more than $1 million. Whatever that number is, those are the two, low amount is the amount of money that goes in. If you're funding it 12 to 18 months, high is whatever the market's going to pay for the company in terms of putting in. In general, venture folks tend to want to own at a minimum 10% of a business and probably at a maximum about 1/3 of the business. There are people who try and own more, and there are some people who don't care about ownership and own less. The reason for us on the low end is you need to own enough of the business that if it turns out to be a massive outcome, it gives you a bunch of money back as a venture investor. If you own like 1% of a business, and that business has to be really, really, really massive in order for you to make money. So 10 is a good rule of thumb on the bottom. If you own too much of a business, it's really simple what happens. If that business turns out to be successful, the founder wakes up one day and says, these guys own too much of my business, something is wrong, and there's some kind of renegotiation. And by the way, it specifically happened to Jack Ma at Alibaba, right? So what did he do? He formed Ant Financial, which he owns himself, right? Which Alibaba shareholders have a very small stake in. And he basically created a brand new business from scratch, which is really effectively part of Alibaba. but it's not Alibaba, and that's how he that's how he got his equity ownership to self-correct, because nobody would come in. And usually what happens is a founder will have a conversation and say, I'm leaving. It's not worth it anymore to me. You go to the venture guy. You're not going to step in as the CEO. You don't know who the people are. Like, good luck trying to manage this thing, especially if the founder is really key. So you don't want to be in those kinds of scenarios. And there are multiple financings, right? So if you own too much, then the next investor wants to own too much, and then the investor after that wants to own too much, and it's zero sum, right? And the founder only goes too low. The general rule of thumb is like 20 to 25%. And then over time, that gets diluted down to like 15 to 20%. So if you look at if you ever read like IPO filings for fun, and you look at people's shareholding, you'll see that it will be in that 10 to 20% number for most venture funds. So you have a numerator, and you now have a percentage. So simple algebra, you know what the denominator is going to be. The denominator goes up when the market's super competitive, and the denominator gets set by the venture fund when there's no market and you're the only investor. But you kind of have a rough feeling. You don't want to lose deals as a venture fund on price, but you also don't want to overpay for stuff. Somehow or another, the market functions. You come up with a number and you agree to terms with the founder. We have our cheapest deal. Our lowest valuation deal was 2 million quid, so about $3 million. Our most expensive deal was $50 million. You know, it's a pretty big range. We're somewhat valuation agnostic. The 50 million sucks for us because we own very little of that business, but that business happens to be Darktrace, and it makes all of them, like our entire fund is returned off of that investment. So we massively overpaid at the time for Darktrace, but massively overpaying for something is fine if that's something. Darktrace is now, it's public, it's worth $1.25 billion, right? So I paid 50 for something that's now worth $1.25 billion in 3 years. It's not so bad. Most businesses won't grow that fast, so I'm less likely to want to pay 50 from the very early days. But that was a serial entrepreneur team. The tech was built. They had a bunch of reference customers. They put their own money in, right? So there was a whole bunch of stuff beyond why that value, to explain why that valuation was so high. Now I'd say most deals in Europe get done at somewhere between $3 to $6 million, maybe $3 to $8 million, and the really good deals probably get done at like 10 to 12. Yeah.
Hi, when an investment company finds you and you can tell early, or rather the question should be, how can you tell early what they're out for? I've seen many companies in for pooling information or gathering market insight into the specific industry. How can I cut it short, or how can I see early on if they're actually having a sincere interest in that company?
In the venture fund, like is the venture fund interested in the company, or the other way around? So remember, I said most of us are pretty lazy, right? And you can do a ton of social engineering to make your financing rounds much easier. The single biggest human driver in the venture industry is a fear of missing out, right? If you know that a particular company is being courted by Benchmark and by Sequoia and by Accel, right? You as a smaller firm, you know, or even as maybe a bigger firm, do everything in your power to make sure you're also seeing the deal. And so the best way to keep the venture community honest and to know if they're serious is to run as close to an auction as possible. So you have to get multiple people interested. And you'll know if people are serious or just wasting time, because if they're really serious, they're going to be scrambling to try and figure out are they going to do it or not, and then present you an offer. And usually that entire process takes somewhere between 2 weeks to 30 days. It shouldn't take longer than that. If it's taking longer than that, it means you're not creating an auction. It also means that they may not be serious. It's super, super, super easy for a venture fund, especially one that's not small like us, to take a wait and see approach, right? Because if you're a big fund and you're like 200, 300, 400 million bucks, whether you write a $5 million check, or you write a $10 million check, or you write a $20 million check, it doesn't matter. You're writing a check. The bank balance is big enough where you can justify writing any of those checks. The valuation kind of matters, but you know what? I'd much rather pay a higher price for a company that I know is going to go somewhere than invest a little bit too early and have to deal with a year or two of risk, right, of doing all the hard work of building. So most venture funds take a wait and see approach. This is a very natural thing of having a bunch of money. If you have very little money, then you have no choice but to invest early. But if you have a bunch of money under management, you generally take a wait and see approach. So if they're doing meeting after meeting, by definition, it's a wait and see approach. So you have to figure out a way to engineer a way around that. And the only way to keep people honest in this market is to run an auction, is to run a market. They have to know and believe, and they have to believe. And by the way, all the venture firms gossip, like all of us. We all know each other. Many of us are friends with each other. We talk notes all the time. We say, have you seen this company? When we're in a super, super, super competitive deal, we don't talk to each other at all. But when it's a really bad company, you know, there's not really that much of a reason to talk. And if it's anything in between, we're like the biggest gossips in the world. So the only way to make it seem, prevent people from doing the talking and the sharing is to make it super competitive. Unfortunately, this is like way easier said than done. But it goes for us as well when we're raising funds. You always need to create artificial scarcity, because when you create artificial scarcity, people feel that they're going to miss out if they don't do it. And if they don't do it this time, they may never have a chance to do it in the future. How you engineer that is a bunch of work, but you can do a lot of things to try and socially engineer that.
Can you tell us a little bit about why you're investing in Babylon? What you think of that market?
Yeah, so why do we do Babylon? So our view, again, pretty simple, right? So we think if you look at the fundamentals of healthcare, healthcare grows faster than inflation. So you can't have a sustainable model in healthcare over the long term unless you figure out how to solve this. In the UK, the primary gatekeeper for the NHS is your GP. And the system, the part of the system in the UK that's massively overloaded right now is the GP surgeries. And if you look, they're not really technology driven, they're people driven. So we think some amount of stuff needs to happen there. When we met the company, there was some talk of AI, and there was a little bit of AI, but there really wasn't that much tech just yet because it was super early days. You know, their goal was to try and build telemedicine to augment the GP or to take off some of this load. About 50% of the emergency room visits in this country receive no follow-on care, which means what people are doing is they're going to the emergency room and getting seen because it's too much of a pain to go get seen by their GP. And none of this stuff is sustainable. So we can understand how telemedicine could reduce that. Their theory was that we could build a software, like a software brain, a software robot, that could do a lot of what the GPs do and either enhance what they do or try and do some of the early diagnostics that a nurse, et cetera, would do. I would say the probability of success looks a little bit better today, but when we invested, it was probably less than 1%. Tiny. But if it all worked, if you could build the brain, if you could get the NHS to endorse this and certify it and make this something that's compliant, if you could get the users, this would not be like a $200 million company or a $300 million company. This would become a multi-billion-dollar company. And to be quite honest, it probably has a chance out of everything in our portfolio to be like a $50 billion or $100 billion company. It may fail, but remember, I don't worry so much about failure. I worry about the upside. So the upside more than justifies the risk. You get no credit in the venture business by being analytical and writing a blog post. You only get credit when you actually put dollars in the game. Because what ends up happening in these businesses is if they go well, they get so mispriced from your perspective as an early stage fund that you never have another chance to buy in. It's not like you're a public market equity. You can wait like 6 months and do it at the next earnings call, right? You only get one shot to buy shares. And if you're intellectually right about stuff but then not a participant, you don't get anything. So the only way for us to learn is to write the check. That's why most of us run portfolios. But that was the investment thesis for Babylon. If you read our investment memo at the time, most of our investment memos are very negative. They explain all the bad things that can happen. We have a whole list of bad things, and then it says, if these pieces all line up, maybe there's a chance of this company becoming really big. And it feels like, at least in the last year or 6 months, that looks like it might go the right direction. And to be quite honest, we won't know for another couple of more years.
What's your view IPO route makes sense, especially as a minority sort of follower?
So what's our feeling on the IPO market and the decline of the IPO market? So the IPO market's actually been pretty bullish in the last like 12 months, but you're right, most companies are not going that route. In the U.S., which is I think the IPO market, I have friends at the LSE who try to convince me that the market here matters, but I think if you're a tech company, your listing option is really the U.S. for the most part. In the U.S., it's a pain in the butt to list. Right? There's a bunch of regulatory stuff, Sarbanes-Oxley, like it's just stuff that you probably don't want to go through. And right now, the private market capital is so big and so vast. There are a whole bunch of people doing private market things, i.e. a SoftBank Vision. Why would you want to go public and be in the public domain and have to, produce earnings every single quarter and be under hyper scrutiny, when you can stay in the private markets, get just as much capital, and not have to deal with any of that stuff? And there's a whole willing community of people willing to invest into the private markets. It makes it harder for people like me because we end up owning shares in private companies, which we can't get out of, right? Because they're private, so you have to do secondaries, etc. But for a founder, it makes a lot of sense, especially when the private money is widely available. And the private market, because there's such a big amount of it today, it tends to, again, supply demand, it tends to overpay. So if you look, most of the private, and there are a bunch of IPOs that have shown this out, the private market valuations were higher than the public market valuations when they go out. So if you're a founder and a CEO, why do you want to take public market at a lower price with more hassle than private market money, which lets you stay independent and pays a higher price for your business, which means that it's less dilutive. And that explains why less companies want to go public these days. Pretty basic. And yeah.
Somehow mentioned, but still, I'm not sure I understand in what stages you are investing. I mean, do you invest in an MVP?
So where do we invest? So we use between seed and Series A, and that's kind of our sweet spot. We tend not to do seed, like pure seed, like we do it once in a while.
Would you like to meet the company in seed?
Yeah, we're super open to meeting companies, before they even raise money, right? We like to be helpful, and it's good to build a relationship with the firm. The reason why we don't tend to do sheet of paper stuff is here in the UK we have EIS and SCIS, and to us it's like dumb money that gets invested, and it's tax beneficial to the person who's investing in it, because if it's SCIS, they get 50% of it back anyway. Why do I want to compete with that, right? That's always going to be more likely to take the risk and pay a higher valuation than I will, because if half your money's coming back, it's a hell of a lot less risky for you to take the check than for me to take the check. But SCIS caps out at 150, so I don't like doing under 150. And to be fair, I think it's better for the founder to get that money, from people who are willing to pay a higher price for it. I like doing the investment after that and not competing with the SCIS money, because there's a lot of it available in the market. My fund is 40 million, so it's not super big. So the biggest check that I can write is 2 million. Pick your currency, it doesn't make that much of a difference. So I like investing somewhere between 250 to 2 million. And I tend to prefer investing about $1 million. So then the question is, where is $1 million appropriate, right? It's somewhere after seed, and it's somewhere before Series A. Because if you're a really good company and you're going to do a Series A these days, you can probably raise like $5 to $7 million bucks. So I'm somewhere in between those two stages.
Do you have a limit about scale?
Do we have a limit about scale?
Yeah, at the end, the company will believe that it will be 100 million.
We don't do it. If we think the company is going to be $100 million type outcome, even if it's like super certain, like no risk, right, or very minimal risk, we don't do it. So the logic is as follows, right? So as a $40 million fund, we get to make about 20 investments in our cycle. We run a very, very, very high risk type business. Remember I said, and there's a bunch of data around this, the failure rate for us is about 40 to 50%. every time we write a check, it means, so imagine like we could take 5, like just think about this like as a conceptual, right? Imagine you could do 5 investments that are not super risky, right? And imagine you could make money on those. The problem then is you have 15 checks that you can write that are going to be the high risk ones. I need every one of my checks for my high risk ones because my probability of success is so low. I can't say I'm going to take like a portion of my high risk stuff and make it low risk and then manage the high risk stuff that way. I am by definition entirely high risk. My probability for a company to become a big tech company is like 1%. I can only make 20 investments. I can't make 100 investments, right? I need every one of those bets. So I can't use up a bet to do something that I know is going to be a low value outcome. By the way, 100's not low, right? As a founder, I'd love to build a $100 million business, right? If I own 50, 60% of it, it's a home run, right? But I can't do it as a fund because it won't make me enough money. So every single one of my things is high risk, high return, and it's like 20 of these, right, that I can do. And that's why I don't do low. So if someone came in and said, look, I know who the buyer is, I know what needs to happen, I'm pretty darn sure. And then the other thing is, even when you're pretty darn sure, our business is not certain. Lots of things go wrong. More stuff goes wrong than goes right. We had a founder in our fund, business is doing incredibly well. And about 6 months later, he called me up and said, I just got diagnosed, I'm bipolar. I was like, that explains a ton. But I had no idea until he told me, right? He was very mature about it. We started going on medication, right? He was like very, very, very good about it, very adult about it. He was a young guy. It was the first time that he found out, right? But he was like, he handled it really gracefully. But in the process of handling it, he was basically out of commission for about 6 to 9 months. Drugs don't work immediately. You have to figure out the right balance. He wasn't the same guy that he was when we invested. Company wasn't the same. He was super critical. I mean, the company was like 30, 40 people, so it wasn't like he was the only person. But he was super important to the health of that overall business. He was out of commission for 6 to 9 months. It didn't. You can't. We ended up having to sell the business. It ran out of cash. It wasn't profitable, right? We got back about 50, 60 cents on the dollar, so it wasn't even a massive outcome. It's a kind of a sad story, right? They had a lot of potential, but what happened is they ran out of cash. Nobody else would fund it. We funded it. Ran out of cash a second time. Nobody else would fund it. And then you got to find the thing a home, right? Because it had. If this all happened and the revenues continued to go up, super fast, which is what was happening in the early days, then his disease wouldn't have made any kind of difference. But his disease happened. He couldn't be there all the time. Revenue started plateauing. All of a sudden, you looks like a high growth business, but now it's a high growth business that's flat. And you go talk to other investors, and they're like, we don't know if this is a really good business. You're like, look, it's a really good business. It's not. It's the founders going through a difficult patch, right? There's not much you can do. And then at the end of the day, you're going to completely run out of cash, which means you're going to completely go to zero. So you find someone to buy the business, and obviously you don't end up getting a huge price for it. You just don't know these kinds of things, right? At inception. So even when they don't look that risky, this is a very risky type of business, which means that when we win, we need to win really big. Yeah, so apart from new markets, is there any industry? So we only do software. So we don't do like deep semiconductor type stuff. So we wouldn't do like a Graphcore, even though it's a great business, right? We don't tend to do businesses that are super capital intensive that we know up front, because our money won't go very far and the company will raise tons and tons of money and we'll kind of get wiped out in the process. I say that, but Deliveroo raised tons and tons of money, but it was all mostly really big up rounds. That doesn't make that much of a difference. And then if you look at our portfolio, so we have a very eclectic portfolio, right? Because these new markets, they don't, especially in Europe, they don't cluster. So it's not like Europe consistently produces one type of company, with maybe the exception of gaming. Like mobile gaming does really well in Europe, and there are multiple big companies in Europe that are mobile gaming companies. We have a travel business, we have an AI healthcare business, we have a cybersecurity business, we used to have a farming agriculture technology business. We have a couple of analytics type businesses. It's a very diverse portfolio. The only thing that kind of unifies it is it's all software driven, And then it's all evidence of new markets, things that couldn't have existed up until pretty recently. And we're pretty open-minded. Like, we don't specialize. We're very generalist. We know that we can't invent these kinds of markets, and we're not smart enough to figure out what's coming around the corner. Because, to be quite honest, if we were, we'd go off and build our own companies, capitalizing on the markets. Like, why should we own 20% of a business and be a passive shareholder when we can come up with the idea or the market and see it and own like 100% of the business? And it's just much better to be the business person building something than someone just investing in something. But we're not smart enough to do that. So we tend to listen a lot. And usually when there are new markets, that idea comes up in multiple conversations. Multiple people pitch you around the same time. And then for us, the question is, which one's the one that's going to scale? Yeah?
So enterprise software businesses have longer sales cycles. You mentioned that.
Yeah.
Across your portfolio of experience, which industry verticals are maybe more quick or more slow that in terms of that sales cycle of buyouts?
So enterprise software businesses have long sales cycles. Which one of our businesses have short sales cycles, or
are there particular industries that you might?
Which industries have shorter sales cycles? So that's hard, right? So I think anyone who sells into financial services or telecommunications, it's going to be really hard from a sales cycle perspective, because if you look at the typical bank, what they tend to do is run a pilot of some kind, put together a budget for the pilot, then they usually plan out 12 months in advance for what next year's budget's going to be and what technologies they're going to adopt. So you're trying to get them to use your stuff and then pay you for your stuff despite the budget that they've already planned for 12, 18 months. It's really hard to do. What usually ends up happening is you get the budget 24 months later, so you end up with this ridiculously long sales cycle. When you win, you may win a decent contract, but you have to survive for 2 years to be able to get the contract. So that's a hard place to sell. Same goes for telcos for the same reason, because they have long budgeting cycles. The only way around that is if you're selling something that's such an immediate pain that they figure out how to create a budget almost artificially because it's that much of a problem. So we tend to look for very deep pain points. It's the easiest way to overcome the sales cycle. If you're selling to the tech industry, the sales cycles are actually significantly shorter. So there's a lot of value in building software, and your early customers should be other bigger companies in the tech industry, because it's much easier to walk in the door, it's much easier to pitch them. Most of them are more early adopters than the traditional businesses, and then you can start generating revenue, generating momentum while you're courting the longer, bigger companies like the banks, etc. So if you're building say networking software, right? And there are people who've done this, right? Facebook is not a bad client, right? Because they invest in this. The same goes for storage, etc. Versus selling to the banks. You'll get much shorter sales cycle in the tech industry than you will with these other guys. But the only way out of, conceptually, the only way really out of this problem is you sell something that's such a big pain point or becomes so readily apparent as a pain point that you can collapse the sales cycle. So right now the Darktrace sales cycle is 45 days, 60 days. What they do is they scare the hell out of you. They get you to use their software and take their box, and then their software is so darn good that it finds stuff lurking in your enterprise that you don't know about, and when you see it, you can't unsee it. And so you get really worried that there's more of this, and you just have to know what's going on in your network for very good reasons, and you tend to go figure out how to get a budget and buy the darn thing. Fear is a really good way of selling. It's much better than value add.
Airbnb is famously known to get rejected by 5 VCs.
Yeah.
Has there been any companies that have approached you and said, damn, I should have invested in those?
Oh yeah, tons. I mean, we have a running list internally of companies that we turned down and have turned down. So I'll give you a few, right? I mean, some of them are small, some of them are big. So we spend a ton of time with Magic Pony. Magic Pony, for those of you who don't know, is a London-based company. If you guys ever watch a television show, Silicon Valley, it was basically Pied Piper. So their goal was, we're going to build software that uses some AI and it figures out a next generation compression technique, and we can significantly compress a video way beyond anyone else. And so we know, not me, but my business partner knows the head of Google Hangouts. We knew Netflix, we knew Amazon Video. So we called all the people in the industry to, first of all, figure out, is this like real software? Because it sounds like a TV show, and we don't know if this is actually real stuff. So we did a ton of work, and we realized it was real stuff. And then the question that we asked all of these guys is, would you use it? And consistently, the answer we got from every single person was no. We're like, well, why not? Like, if your file size goes down by 30%, and you're shrinking this video, like, why would you use like an MPEG-4 versus these guys, like when they can bring the bandwidth cost significantly down? And the universal answer that we got from people was, bandwidth matters. Like, if you're Netflix, bandwidth matters. But we care a lot more about growing our user base than we do about optimizing our data center. So it's like important, but it's not like on our list of priorities. Weird, right? Because like, if you can significantly shrink your file size, you can significantly save your bandwidth. Like, and if it doesn't take that much resource to switch, you should switch, right? You'll save so much money. These guys weren't interested in the saving money stuff. They were much more interested in focusing on how to generate more content, get more users, right? Because they're in Amazon, Netflix, they're all in a war with each other, right? To get our customers. So optimizing wasn't on their list. And so we ended up passing. But the tech was real significant, right? There was some like real innovation. And what ended up happening, and this is where we don't have any insight, right? And they started selling to predominantly African telecommunications companies. Because if you think about it, where do you need bandwidth compression if the Western markets don't really care, and the Amazons and the Net, and you're doing video? So you go to the telcos, right? And especially in places where bandwidth is constrained. But then you have this problem of really long sales cycles, inertia, late adopters. I mean, you know, so the company wasn't doing phenomenally well. It was like making slow progress. And then all of a sudden, around the same time, Twitter, Facebook, there were a couple of privately held companies all decided to do like short form video on your mobile phone. And you don't care about the bandwidth cost, but you care about how fast the video loads on your phone. The faster the video loads on your phone, the better the user experience, and the drop-off rates, people abandoning, come way down. So for those kinds of guys, like the Vines of the world, it really matters to have a small file, because if it's a small file, it pops, and if it pops, people look at it. And Magic Pony then came to these guys' attention, and then there was a bit of a price auction between multiple people, mostly these people doing short-form content, and the company got acquired for $120 million 1 year later. I wish we owned 10-20% of that business. We would have made a lot of money for our investors. For the right reasons. We didn't think it was going to turn out to be a massively big company, and we thought the sales cycle was going to be really low, but like in hindsight, I wish we did it. We turned down Monzo, the banking company. So Tom was the founder of GoCardless. I was an angel investor in GoCardless. He came to me. We looked at it, and we had one question for Tom, just one. How are you going to get customers? Right? It's a pain in the butt to get customers for a new bank. And the average customer cost is about 400 pounds in the industry. It costs about 400 pounds to acquire a user in the banking industry. That's why like NatWest will give you 50 pounds of credit if you open up an account, because 50 pounds is really cheap compared to the 400 that they have to spend in marketing. And his response was, millennials are going to use it. It's like, that's not an answer. Like, you know, how are you going to get the millennials to use it? He's like, millennials don't like banks, they're going to use it. I was like, no, there's got to be, you've got to have some strategy here to acquire the millennial. He's like, no, millennials are going to use it. Like, now we're like, well, we can't, and we'd love to give you money, but like, no. And today, as far as I know, like the average virality for Monzo is like 1 in 20. So for every person that gets a card, they evangelize it to their peers, and it's about 20 other people who end up signing up. So you get one millennial, you actually get 20 millennials. And it's like that and Revolut are the two kind of challenger things that are scaling up. I wish we did it. Right? We have a whole list of this. And we've done more right than wrong, so we're not that bad, but we're still pretty bad. We have a lot of room for improvement in the fund. But this is natural. right? It's very hard. Like even the best firms in the world, like the Sequoias or the Accels, etc., don't get every single company. It's hard. It's hard to know up front. Yeah.
When you were talking about Monzo, how do you act when it's about not the idea but the experience? Because Monzo as an idea is just another cut, but the experience, the ad, you spend and in real time you see that the money goes. It's nice, you feel good.
Yeah. So
it's
Tom.
not about the experience, but at the beginning when I come to you, it's not about the idea.
So most consumer businesses are like that, and to be quite honest, I don't think I'm a particularly good consumer investor, right? Because if you came, another very experienced type of company is Snapchat, right? And I'm pretty sure that if someone brought me like if Evan and I met, I wouldn't get it. Like, I'm too old, quite honestly, right? It's not my I'm 41 years old. This is not my generation. If someone said, and if you look at like the early versions of Snapchat, they were like ugly and unusable for old people like me. Like the high school kids all got it, but like I would struggle with Snapchat to figure out, like I didn't think this was like an intuitive design. And it's because I'm like too darn old. So like experience stuff is really difficult for me, especially like consumer experience stuff, because I'm like an old school enterprise software guy. So like enterprise software I kind of get, I know sales cycles, I know engineer them, right? But like consumer type experience businesses are much harder. But you know, when I talked to Tom in the early days of Monzo, he had like very good clarity of thought as to what he was going to build and why this was going to be different. And I was like, I actually, that's a given. Like I don't need to spend any time asking you like how your interface is going to be better. And like I believe you, right? You know, you can show me some stuff and I can see it today, but like in all honesty, if I give you a year and you have a bunch of money, like I'm pretty sure you'll nail the experience. My only question was how do you get customers? And that's the one thing I didn't see. Right. And the way he did it was like, you know, if you sign up, you get some money and you beam it to your friends via text message, and the only way for them to get the money is to open up an account. And nowadays, like I've heard like interesting stories like from people, like if you go out on dates on Tinder and you're like in your 20s, like my generation of people wants like black American Express cards because we think that's cool. This generation like pulls out the Monzo card. It's as much of a statement about who you are. So there's like a whole experience phenomena around the culture of this company that is not for people like me. It's for people who are in their 20s and 30s, but they really like it, and the company is scaling, right? I think it has like just under 1 million users now, and they're very actively engaged. But I don't know if I'm the right guy to figure that stuff out.
Are you involved in that growth strategies and how am I going to gain customers? Because you know, sometimes it's about trying to see.
Yeah, I would argue most consumer stuff is these days it's very data driven, especially if it's online, right? It's very data driven. You largely look at things and you see if they stick. I mean, the guys who do this exceptionally well are the mobile gaming guys, right? You build something, you build a feature, you immediately get feedback to see if people play that feature or use that feature, and then you tune that back in a good kind of business. You tune that back to your customer acquisition. You run lots of cohort type analysis, right? It's a very quantitative way of figuring out features as well as figuring out marketing. You know, we know enough about how people do it to give some advice. We know a lot of people who do this stuff, so we can connect founders to people who are much smarter than we are, so they can get that kind of input. You know, we're not doing the data analysis and doing the regressions, et cetera. So like it's hard for us to give very specific advice other than this is the way you ought to try to do some of that stuff. But most of the companies that we invest in, they have teams that, or they have expertise that's well beyond our expertise to figure this stuff out.
So if you're looking to invest in a company, what are the watch-outs that from a company perspective you should be aware of as a co-founder and pitch the company something?
Yeah, I mean, so the simple stuff that I explained at the very beginning, right? Size of market, is it going to become $1 billion company, et cetera. The other gotchas, like we don't like crowded cap tables, like, it's a pain to have like 60. And like Cambridge, the town and the university has a tendency of doing these like multiple rounds between angel investors. So I remember I saw one company that had something like 10 different investment rounds. It was basically angels investing and then convincing their friends to invest, but at a higher price, and then investing their friends to invest at a higher price. And it was a very, very, very complicated cap table. Complexity is kind of the enemy for us. We're pretty simple. We prefer simple businesses. We prefer simple cap tables. Having like 6 founders is more complexity. We prefer simplicity again. 1, 2 founders, 3 founders. 6 founders, it means you can't figure out who's really the boss. It's just life just gets really tough. We tend to eliminate and stay away from stuff where there's complexity. We think it's kind of the enemy. So anything that is overly complex, we don't like. Any other questions? Good. Well, thank you so much for staying. I know it's late on an evening, so hopefully this was helpful and valuable.
Thank you so much.
Thank you, Hussein. Thank you all for coming. We have half an hour of network opportunities here, so grab a drink at the bar and we'll all love to talk to you. So thank you all for coming tonight.
Which channel? Oh, right. So then on WhatsApp. Yeah, WhatsApp. WhatsApp is another thing. Is WhatsApp different? Yeah, it's different. Because sometimes WhatsApp is not it's not important. You can just add the number and just say hello. It's like a chatbot. Okay. It's for WhatsApp.
So, just a quick reminder, we can continue to stay here until 8:30 for networking and enjoying the drinks and the food. Again, thanks so much for coming today.